Every so often the market gets a little lazy, it ignores the evidence and gets a little behind. This trade is one of those times. The market is making a mistake on the Federal Reserve's next move. So in this video, I'm going to show you and explain you in real time how to spot and understand the mispricings to take clear quality macro trades. Let's get into it. As you know, the number one task of a macro trader is to figure out what the central bank is going to do before it actually does it. See, you have to be able to anticipate rather than react. Because markets move on expectations. The market is smart enough to understand and anticipate the central bank's moves, and so we need to do the same. Let's look at the evidence right now. The market is currently pricing a 54.5% chance of a December FOMC cut. How do we know this? It's not a guess. We'll look at the CME Fed Watch tool. This shows you exactly what the market is pricing as of right now, and that pricing is 54.5. That said, I can say that this 55% pricing is way too low right now. And sure, it's low because of what Powell said at the October FOMC meeting. He threw cold water into the possibility of a rate cut. In fact, on that, we went long the dollar. We went short EURUSD on the hawkish Powell because the December rate cut was not a guaranteed. That's what he said. And so we went short and the trade worked out pretty well. So the market pricing out that December cut led to dollar strength. Perfect. But here's the point now. The October FOMC meeting was about 2 weeks ago, right here. Things change in 2 weeks, and our task is to see the changes in real time as they happen, in order to be able to move with the market and not after the market. See, right now the context is shifting, and you can also see it on the chart. The government, the US government, has now officially reopened, and the data from the US will start to flow in from next week. Now, apparently we may not get the October CPI and NFP, but either way, the labor market was already soft heading into the shutdown. And this 30 days, about 40 days of government shutdown will have hit the labor market even harder. In fact, Goldman Sachs is expecting the October NFP to print quite negative, okay? Now this is not the type of environment that the Fed can afford to wait and see. They're already a little bit behind the curve. They should have started cutting back in July when Waller and Bowman dissented in favor of a 25 basis point cut, but they didn't, and since August the labor market has been weakening quite a bit. So the prudent part here from a policy perspective is to cut rates again as an insurance cut, because you're not going to know what the shutdown is going to produce, so they have to be careful on it. This, in my view, is the most probable outcome of the December FOMC. So it's not 55% chance. It should be more like 80% chance. So this probability should move higher toward 80%. And this is our macro trade thesis built. The market is underpricing a December rate cut, and the upcoming data will force that repricing. So as the market starts to realize that a December cut is near certainty, near an 80% chance, the pricing will move closer to that 80%, and the dollar accordingly will sell off. Therefore, we want to buy a currency against the dollar, and there's the EURUSD trade. See what's going on here? We have a fundamental view of how things will most likely going to unfold from a macro view, and so we position accordingly. Can we be wrong on it? Sure. Maybe the data from the US prints stronger than we thought, and so the macro view is invalidated. But that's how it works. We play the probabilities. Right now, the impact of the government shutdown skews the probability in favor of weaker US data, especially labor market data, which the Fed cares a lot about right now. They're quite worried about the labor market deteriorating further because they know they're behind the curve. And so any further weakening will force them into a cut. A cut that is not fully priced in. It's only 54.5% priced in. Should be closer to 80% priced in. This is our hedge. This difference in pricing is what tells us, okay, there is actually room for the dollar to weaken here, because this pricing is not where it should be. And so that's the macro view. And obviously, of course, as usual, it's paired with a technical trigger. As you can see, in this case, it's the break of this market structure right here, this trend line right here. It breached the trend line, came back, retested, and started to move up accordingly. That's all. That's the trade we took. And it was sent, as usual, to the private network members with exact entry point, exact target, exact stop loss. And then in this case, we also alerted this analysis, this view on our public channel. So the trade as of right now is running, okay? We understand the view. We know that the labor market is most likely going to weaken, and that's going to weaken the dollar, so push EURUSD up, because the pricing for the December FOMC needs to be higher. It's only 55% now, it needs to be at least 80%. But remember, if the data proves us wrong, then the trade is wrong, okay? We have a thesis, we have a view that the market should go higher, so that EURUSD should go higher because the dollar should weaken on the fact that the government shutdown will most likely have impacted the labor market, and that's going to move the December FOMC rate cut expectations from what's currently 55% up to at least 80% or so, and that's going to weaken the dollar. But it all rests on the idea that the labor market and US data in general will actually print weaker. If they do, the trade will work out. If they don't, we'll have to adjust. Maybe we'll take a break even, maybe even a stop loss. That's how it works. So that also said, if you appreciated this deep dive and you want to get more of these videos, make sure to subscribe and like the video so you don't miss the next one.